Good afternoon. Come on in, make yourself comfortable. We'll just give it another minute for everybody to get set, and then we'll kick off. Good afternoon, everyone. We'll just give it another 20 seconds. A few more people joining us, which is great. Thanks for coming along. We'll get started in about 10 seconds. All right, good afternoon, everyone. Welcome to our webinar. As you can tell from the picture, I'm Jeff Thurrock. I'm a director and advisor at Evalesco. This is Bruce Grieve. I'll tell you a little bit more about Bruce in a second. But today we're going to be talking about Star Trek, Homer Simpson, fear and greed, and lots of great charts and graphs, and all with the aim of understanding a little bit more about how our behaviour can impact on our success. So as I said, I'm joined by Bruce Grieve. Bruce joined us as an advisor 2 years ago, coming from South Africa, where he's an advisor for 17 years. Bruce is really curious and passionate about trying to understand why we do what we do and how, as advisors, we can help our clients to manage their behaviour for better financial outcomes. So welcome along, Bruce.
Thanks, Jeff. Good to be here.
Going to have a fun chat for the next 45 minutes or so. So before we get started, just letting you know that, click through to the next slide, it's going to work. You are in view only mode at the moment, so we can't see you or hear you, so feel free to move around and talk amongst yourselves. We do, however, encourage you to ask questions. So you can see on the screen there down the bottom, there's where the green tick is, there's a Q&A button that you can press to type in any questions, and we'll be able to see those as they come up. So if you do have questions, we'll try to get to them on the way through. Otherwise, we'll definitely leave some time at the end to cover off on those. Also, don't forget that everything we're discussing today is general advice only. We're not taking into account your personal circumstances through this conversation. So if you do have any questions or you would like to discuss how it might relate to you specifically, get in touch with your advisor and we can help you with that as well. I thought it might be wise also to put in a disclaimer today that Bruce and I aren't psychologists or psychiatrists either. So the advice and the things we're talking about today aren't advice in that context, but we're going to try and be as helpful as we possibly can.
Yep.
So we'll kick it off. Bruce, I've just provided that disclaimer that, you know, we're not psychiatrists or psychologists, but hopefully everybody understands that we've got a bit of an idea about what we're talking about in regards to investments and economics and that sort of thing. Having said that, we're here to talk about behaviour as part of it. So why are we talking about behaviour?
Yeah, Jeff, I think a lot of people in the industry for a long time have known there's a relationship between fear and greed when it comes to investing. So we know that when the market's at peaks, people are most confident and optimistic, and there's an element of greed that comes into our emotions and how we invest. And likewise, when the market falls, investors are fearful and they act upon that. So I guess we've known for a long time about the sort of fear and greed mentality, but there hasn't been much research to back up what we saw happening with investors and what we experienced as advisors on a sort of day-to-day basis. So I guess if you look at, and this analogy has been used a number of times, and you know, traditional economics would be similar to Spock. So it assumes that people are rational. We don't have any problems with self-control. We've got lots of willpower, and we make smart decisions. So if we're making a decision, we're going to read all the available information and we calculate it like a computer would do. There's no emotion, there's typically no mistakes, and we do it. So that's what Spock is like. And then behavioral finance or behavioral economics is looking at it and saying, hang on, it's the study of the psychology of financial decision making. And so it's saying, hang on, we see what people are doing on a day-to-day basis, and it's contrary to what the economics model looks like. And so they went to explain that. So behavioral economics explains the biases that we're all prone to and explains why we act a bit more like Homer than Spock on a day-to-day basis. Which I see more in myself than homer at times than the SWOT.
Yeah, definitely. That seems much more real life. Yeah, for sure. Okay, that makes sense. So how does some of this relate to, I guess, finance and investing?
Yeah, so I guess because we've got these two characters, and so I guess there's an element of SWOT in us all. So we do behave like that at certain times, but there's a lot of homer in us. So we try and find that balance. And I guess how it plays out for most of us is that as humans, we're incredibly gifted. We've got the ability to do amazing things. So this image that we put together here just shows, going back years with the pyramids, and slowly as we've sort of evolved and our skill sets have improved, we've got buildings that are now sort of 800 meters into the sky, which I guess seems odd when we say we're a bit like Homer Simpson because we built these amazing structures. I think when you fly overseas and you get on an A380 and it's this enormous plane with sort of 800 people flying across the globe, it seems amazing. And then we look at this research that says, hang on, we keep making these silly mistakes and it's costing us money or costing investors money. So it's trying to understand that, I guess. And
hard to reconcile when you look at that progress with some of the basic things that we do wrong and silly mistakes that we see all day every day.
Exactly, yeah. And it's not that we're stupid or that we're silly. It's something that's sort of built into our human psyche and that's evolved over years. And it's very difficult to break that cycle because it's just a bias that we all have an element of. So I thought it'd be quite good to show this video, which was research done in 1960, and it relates to conformity and human behavior. And so it's quite strange when you look at how amazing we are and what we managed to accomplish, and then you look at how we act in certain situations. So we'll give this a play. It's a couple minutes long, but it's pretty entertaining and just shed some light on how we act.
Sure.
The gentleman in the elevator now is a candid star. These folks who are entering, the man with the white shirt, the lady with the trench coat, and subsequently one other member of our staff will face the rear. And you'll see how this man in the trench coat tries to maintain his individuality, but little by little, he looks at his watch, but he's really making an excuse for turning just a little bit more to the wall. Now we'll try it once again. Here's the candid subject. Here comes the candid camera staff, 3 of them at least. And this man has apparently been in groups. Here's a fella with his hat on in the elevator. First he makes a full turn to the rear and Charlie closes the door. A moment later, we'll open the door. Everybody's changed positions. Now we'll see if we can use group pressure for some good. Now, in a moment, on Charlie's signal, everybody turns forward. There it is. Notice they take off their hats. And now, do you think we could reverse the procedure? Watch.
Pretty amazing.
Yeah.
Yes, I guess as I was saying, it's quite strange to look at how we behave in different situations. And I think when there's uncertainty or we're unclear on something, we sort of follow the herd. As the picture shows you, and it looks good, so let's just follow the crowd. And we see that a lot with investing, and I think that's it. So if you're at a barbecue and someone's talking about a share that's going up, then obviously they're likely to go and say, well, I'm interested in that, and they want to start looking at it. And the more people do this, it sort of creates this herd mentality.
Yeah, and that's why they talk a lot about momentum, isn't it? Momentum with investing, and that comes just from people piling into it and following each other and building it up, and it becomes a self-fulfilling prophecy sometimes. So
yeah, if you think about that, that's right.
Yeah.
And I guess the strange thing is that herding was a natural instinct years ago. So I think if we take a step back and go back a few 100,000 years, and coming from South Africa, if you imagine you're on the African plains years ago, the way you reacted then is very different to how you react now. The world's very different. So back in those days, if you were walking along in the bush and there was sort of thick grass and you heard a rustling there, it could be a mule or you could be the mule.
Yeah.
So there were two options that you had. So what you did was you said, well, hang on, if that's a lion and you run away, you've done well. You've saved your life. If it was a mule, you maybe missed out for a day or two until you get your next meal. And so if we carry that sort of mentality back into the current world, it doesn't work, because as soon as we see fear nowadays, when it comes to financial markets, we run away from it because it's our natural instinct to try and protect ourselves. And so we try and remove ourselves from the danger, which, as we'll chat later on, that causes issues from a financial point of view. So what worked years ago isn't relevant now.
Yeah, and we've seen studies done which are crazy, showing that psychological and physiological changes to your body in the face of a lion or a falling share price, your body reacts the same way, which is crazy, isn't it? To think that one you should be scared of, the other one is quite a different sort of I guess proposition. So
as you say, I remember there was research done on MRI scans, and what they did was they looked at what a person who's looking forward to a cocaine hit, what their brain does and how it lights up on the scan. And they looked at someone who anticipates a good return on their investments, and apparently it's quite scary. It's almost identical. And so we sort of get addicted to this positive return. And as soon as you take that away, we start having these, I guess, withdrawal symptoms when that happens.
Yeah. And this is, as you said, this is an ancient phenomenon sort of built into our brains, but it's also, there's been examples over the years of how this is, hasn't changed a lot, I guess, even though we've got modern technology and different ways of approaching our portfolios. But it's been going on for years, and some good examples that you've got on this slide. Yeah,
so we put together a few here for people that you may be familiar with some of them, but the tulip mania was a sort of craziness that happened in Holland in the 1600s, and essentially what happens was that there were these tulip bulbs that became rare, and they were sort of crossbreeding them, I think, and you had these sort of strange colors and whatnot. And because of that, people started becoming completely irrational about the cost of these bulbs. And so at some point, they were costing 6 times the average person's earnings for a tulip bulb.
For one bulb.
And I think in current dollar terms, they were selling for sort of $750,000 for this bulb. And it became a bit of a lesson in greed and speculation. People were trying to leverage the ability to buy a bulb, and they would plan to then sell it at a later stage. And so the degree to how much of it was completely true or not is up for debate, but it was really a lesson learned on greed and what it did to people at that point. Another one that's really famous is the South Sea bubble, and this was a true bubble. And what's great about the story, we've tried to say, we're not all like Homer Simpson. Even those people that are incredibly smart. So this one involved Isaac Newton, and what happened was South Sea was the hottest stock in the UK. I guess it's like an Amazon or a Google, and everyone wanted to be in it. And Isaac Newton was in the share, and he made 100% profit, and decided, okay, well, now's the time to take his gains. He sold it. He was happy with his investment, and then his friends were obviously still in the share. It started to continue to go up, and so he realized, well, I've got to get back in now. So he bought in at a higher price, and then subsequently it went bankrupt, and he lost all of his money on that one share. And so he famously quoted something to the effect that he could calculate the movements of heavenly bodies, but he couldn't understand the madness of people. And which is exactly what happens nowadays.
He's a super smart guy who still falls prey to the same old inbuilt biases and traits that we're still putting up with now.
Yes, that's a great one. Then the Great Crash, which led to the Great Depression, what must have been quite a scary time to live through. I mean, I recall looking at the data, and there were two consecutive days of minus 12% return falls over that time period. It took about 3 or 4 years for the market to fall 80%, which, you know, we get worried nowadays if the market's down 5%, the news are blaring about how we're in a decline and it's the end of the world. And so, you know, the Great Crash was really an extreme cycle that we lived through. And part of that would have been a hyper build-up prior to that, which was definitely the case in the tech bubble. So if you look at that, the curve just goes almost straight up over that time period. And if you recall, I remember they were reading about articles where companies were changing their name to sound more techy.
Yeah.
That whether it was
if
this dog food company put, you know, dog tech or something, and the share price would climb. And so you know, we sort of, this human behavior just cottoned on. We just started getting greedy, and the market fell there 75%, and the NASDAQ, I think you mentioned, took sort of 15 years to get back to even keel, which is pretty amazing.
Yeah, I remember this personal story. I had some shares in a tech company then, which was a Sydney-based startup, which I had a friend who was working there, and so we bought some shares, and then I went away overseas for 2 weeks, and I think it might have been Marshall rang me or sent me a message and said, you should, you know, probably get out. The price has gone up. And I said, I'll have a look at it when I get back. I'm on holidays, don't worry. By the time I got back, the price was a quarter of what I paid for it, you know, which is a tenth of what it was when he sort of called me.
Incredible.
So that was in the middle of that. So back then I didn't have a lot riding on it, but it's still, you know, perfect example of what happens.
Yeah, and I guess it's easy to look back and say, oh, we knew it was a bubble and we knew it was this, but when you're living in that emotion of just this fear and this cocaine equivalent hit that you're getting as it's going up and up and up, it must be an amazing feeling seeing your returns just skyrocket. And we probably aren't that rational in, can this continue? Is it going to fall? We just get caught up in it.
Yeah, that's right. And so that's where the fear and greed comes into it, and the typical cycle of how we invest when we feel confident. When the market's up, everybody's thinking things are good, and so we want to buy and continue to ride that, just like Sir Isaac Newton did. And then when we feel that fear kicking in, everybody's looking to get out. And as the slide says here, repeat until broke if that's your strategy.
And it's quite a great graph we use, and just giving reference to the Behaviour Gap, which it's an American advisor who now advises to advisors around the world, and name is Carl Richardson, and he sort of started coming up with a lot of these theories, and he sort of, not the theories, but a way to illustrate it, that the average person could understand what was going on. And it doesn't mean that it prevents people doing it, it's just an easy way to show what's happening and illustrate it. That's
the mentality, you know, nice simple graph or nice simple picture there.
Exactly, and so I guess the question often is, well, you know, do we need to wait for a market crash before we lose wealth? Is that going to affect us? Is that the only way that we actually have these big dips and losses of capital? And the answer is no, because those cycles happen on a broader scale quite frequently. So this is a great graph that goes back to 96, and you'll see the sort of black line that's sort of climbing to the right shows the S&P 500 index over time. You can see it's had a couple of where we've highlighted in red 3 key points where there's been a downturn. And what the blue line is showing you above the horizontal axis is that it's showing the 3-month flows into the portfolio, into the index. So as human behavior happens, we know what's happening is that as the market is going up, you've got a huge pouring of funds into the portfolio, which is exactly what we know what happens.
So that means this blue here is showing how much money people are investing. So over and above what the normal flows are, I assume. So, you know, here you can see the market's gone up and all of a sudden people are wanting to buy that portfolio in much greater numbers with much more money.
Yep. And then as soon as the market starts to fall, you can see it, the blue bar moves below the curve, which means there's negative flow. So money's coming out of the portfolio at exactly the wrong time. And that's that fear and greed that happens. And, you know, you extend it to 2008, 2009, the same thing happened. As soon as the market starts to recover, money flows back into the index. And as soon as it turns and there's a dip, the money flows straight out. And currently we're seeing that now from 2018. It's been the same, slightly different in that there's been huge outflows each time there's been a decline, and because it's been so volatile, you just had this flow of cash moving out of the market.
Yeah, so we can see here that there's money coming out, but there hasn't been a lot going back in the upswings, which might normally be the case because, as you said, that ongoing volatility, so people are still potentially sitting in cash and may have missed some of this.
Yeah, and I think there were stats that were shown with Australian Super where they had almost 80,000 members. As soon as there was that volatility in the start of the year, they moved into defensive portfolios, and the markets then had a great recovery, and they missed out on that completely. Yeah. And I think it was sort of 5% was the gap of what they had missed out over that period.
Yeah, because it's really hard to know when to go back in, isn't it? If you look at that, it's, you know, if you're using a downswing to be a trigger, that can be pretty obvious sometimes. Yeah. But how do you know when's the right time to go back in? And I think that's probably what has led to, you know, like you said, that Australian Super outcome in here where people haven't gone back in. Because how do you know when, you know, has it finished going down? Is the volatility stopped? And, you know, volatility is never going to stop, is it?
No. And I think if you look, like you're saying, in 2000, as soon as the flow started to go negative, as soon as there's a bit of an uptick, the flows are positive and everyone thinks it's going up again, and then the market turns again and the funds flow out. So it's this constant, if you're chasing the market and you're trying to read it, you're typically going to get it wrong, and that ends up costing you.
Yeah.
And so coming back to the graphs and illustrations that Carl Richards has drawn, that cash flow in and out of the portfolios has developed into what's called the behavior gap. And so what that looks to explain is to say, there's the return that the investment gets, in that instance, the S&P 500, and there's the return that the investor gets. And there's a gap between those two. And the reason for that gap is moving in and out of the market. That, you know, when the market's low, we sell it because we're scared and we fear from. We're going back to the mentality from the African plains. We want to protect ourselves, so we take the money into cash because it feels like it's safe and it feels like the better thing to do. And then when the market starts to recover and we feel more confident and there's been some positive signs, then we go back into the market and we miss out on that initial recovery, and we keep repeating that cycle over time.
Yeah. Makes sense.
And yes, so there've been a number of studies, Jeff, as you know, that where they've tried to calculate what that sort of behavioural effect is on clients' portfolios, and it varies from time to time. It depends on what cycle you're looking at, whether it's been a downturn, whether it's been an upturn, but it varies between 2 and 3% over time. A year, 2 or 3% a year. So this is looking at a 10-year period of the S&P 500 and the average large cap fund, and it's just over 2% a year over 10 years. And the difficulty is, like we looked on the earlier graph, is that it's not, okay, now's the time and we're going to make the money. It's small bits that it happens, and then suddenly it's this big effect of you miss a positive 20% recovery, and that blows up the portfolio return.
Yeah. So this assumes that in the red bar with the 15.2%, that you put the money in on day one and you took it out on day,
10 years later.
10 years later. And then the other one is what the average investor did by that buying and selling that we saw. And so they were trading their portfolio, and that's the return that they got, which is the only thing that is accounting for that difference is the behaviour of the investor.
Correct. Yeah.
Yeah.
And typically these calculations don't take into account trading costs or capital gains tax, which may be nothing in this instance if there's a loss. But it's pure just what the figure's shown. I mean, I know coming from South Africa, we had funds that did the exact same calculation, where they looked at not the broader market, they looked at their actual fund. So they would look at their equity fund, or they looked at their balance fund, and they said, well, what's happening here? And it was exactly the same. And that was actual client data. It wasn't just the broader market. So it was really quite telling. And I think since inception, a balanced fund, which is meant to be your sleep easy, it's got some protection built in for volatility, was almost 4 or 5% a year over sort of a 10, 15-year period, which is enormous.
It is, absolutely. So we talked about before, this has been going on for hundreds of years, yet we continue to make mistakes. So why do these sorts of behaviours persist, do you think?
So in the behavioural economics world, where they've done the research, they've effectively highlighted that there's two parts of the brain, system 1 or system 2, or sometimes it's called system X and Y, but there's two parts of the brain, and the one is system 1, which, as it says there, is fast, and it has shortcuts, sort of mental shortcuts that it utilizes to to get us through the day. System 2 is a lot slower, it's a lot more logical, and it takes a lot of energy to use system 2. And so, if you think about your average day that you go through, the data suggests we're making about 35,000 decisions a day.
Yeah.
And if you did that in system 2, you probably wouldn't get out the front door in the morning. so that's partly why it starts to happen.
Yeah, no, that makes sense. What are some examples of system 1 and system 2 thinking?
So I guess if you think about it, and maybe it's just me that I'm a bad driver, but if you're driving along on the road, often you find you get to somewhere you think, how did I get here? And you're not quite sure why where you are. You were planning to go there, but there's a gap in your brain as to how you actually got to that point. And I don't know if you do it too, but it's maybe just me. But
that's kind of on autopilot.
Exactly. It switches off because it knows where you're going and it's still alert. It's still looking for what's happening. But as you're driving, you've got a car over there, you've got red lights over here, you've got someone indicating and changing lanes. There's a lot of information getting thrown at you. And so your brain's filtering out what it doesn't need. And it kicks a lot of that information out. So I guess, example of system 1 is that if you're driving along in a car and suddenly a dog runs across the road, you don't sit there and go and think logically, I wonder if I should swerve to the left. You immediately just swerve. You just react. And that's system 1 acting on your behalf. So if I said to you, what's 2 plus 2? You don't use system 2. System 1 just blurts out an answer. And that helps us in a lot of situations to conserve energy, but in other situations, it's not great. So system 2, I guess, would be if you're completing your tax return. You don't want to use system 1 where you just, well, what is your income for last year? Or I'll just guess it's about this. You go and you logically look at it and say, well, what is my income? What are my expenses? What's deductible? And you actually put some effort and time into it. And it takes a lot of effort, a lot of thinking to do that. I guess the other maths question would be if it, 2 plus 2 is system 1, 16 times 32 would be a type 2 question. You can't just give an answer immediately. It's 512. I use my calculator, but it's 512. But that's an example of a system 2 that we rely on at that point.
Okay. So some of the, I guess, specific shortcuts or system 1 thinking that we use, as you said, helps us get through the day-to-day. But how does that come into our thinking when it comes to finances and our sort of behaviour in that regard? And what are some of the examples, I suppose, in that context?
Yeah, so I guess I put a few here that are sort of quite key and get sort of interesting for what we do from a financial point of view. And I'll run through those if that's okay.
Yeah, sure. So these are kind of biases or inbuilt sort of processes that we have.
That's right. Yeah. So so overconfidence is one that is quite a big one. So Jeff, if I said to you, are you better than the average touch footy player on a Monday night? And you probably think you are.
Yeah, absolutely. Not at the moment with my dodgy shoulder, but normally, yeah.
And you probably are. And so it's questions like that we've got this overconfidence in our abilities. And so, if you ask a similar question to a group of 100 people, 75 people will be above average.
Yeah.
And whether it's about driving, whether it's about their looks, ability to tell a joke, they're all above average, which they can't be. Yeah. Some have to be below.
Yeah. I've seen the driving examples where I've done surveys and hey, you're a better driver than everybody else. So
yes.
Everybody says yes.
Exactly. And so that's part of that overconfidence. So what happens is that if we carry that forward through to our investing world, we believe, the data shows that market timing doesn't work, but I can get it right.
Yeah.
Because I'm confident. I know I can. They obviously weren't looking at the right information. I can do it though. Yeah. And so that's what sort of plays out from a financial point of view. Coming back to the driving example, there was one study done in the US where they asked 50 drivers questions and they asked them to rate their skill, their ability, and their alertness. And I think the figures, I wrote them down, 75% that they were responsible, that they were good drivers, they rated themselves as very good or 100%, and yet they were all getting interviewed in hospital because they all had crashes. So they started their trip in their car, they crashed, and they got interviewed in hospital. And
so none of them was their fault.
None of them was their fault. Well, actually, I think 10% said they were partially responsible. And when you look at the police reports, over 55% wrote their cars off. 44% would face criminal charges. So they were definitely guilty and played a big role in what it was, but the overconfidence said, no, it wasn't me. It was the other driver in those instances. So overconfidence is a big one. And I think there's elements where overconfidence is good. You know, entrepreneurs need to be overconfident to start a business. You know, most businesses, half of businesses fail. Where when they asked questions of entrepreneurs, a third typically say that there's 0% chance of them failing. And so you need a bit of that for capitalism to work, for people to be innovative. They need to have this drive. So there's elements where a lot of these biases are good for us, and there's places where it's bad. And so when it comes to the average investor being overconfident, it's probably not great.
What else?
So confirmation is one, and I guess it's quite pertinent now, I guess, with the US elections going on now. We typically look for information that confirms what we already believe. So we've got a strongly held belief that party A or B is the right one. When we go into Google and we type stuff, we're looking for something that confirms what we believe. And if we see something that doesn't confirm it, we ignore it. And we don't go and question what it is that we believe. And so that plays a big role.
Facebook's built a whole business model, exactly, because they only give us stuff that we like.
Exactly.
So you're only seeing stuff that...
And you stay on the Facebook because it's what you enjoy. If they were asking difficult questions of us, click. I'd log out and go find something else. So,
That makes sense.
Herding we looked at already. Herding was great for protecting yourself in the African plains, but now, you know, if everyone's buying into a certain stock, it doesn't mean that it's good. It just means that everyone's doing it. And as you said, it's self-fulfilling, because the more people go into it, the price goes up, the more people go into it. And so that's quite tricky. Loss aversion is, and I think I've got a graph here on that here. So coming back to my little pictures. So loss aversion really is tests they do. So if I say to you, Jeff, we're going to flip a coin, and if it lands on heads, you lose $100. If it lands on tails, what do I need to offer you to take that gamble? And most people say $200. It's around 2 to 1 is what they're looking for. And it's not 2 to 1 odds, because it's still a 50-50 chance when we flip it. It's still 50-50, but the pain of a loss, we feel twice as much as the pleasure from a gain. And so we've got to be compensated. And so I guess when it comes to investing, when the market's up 5%, you might feel, say, 1 unit of pleasure, for example. But if the market's down 5%, you feel 2 units of pain. And so it hurts a lot more when we have these negative returns. And so that's quite a big one when we look to clients. So when they experience a negative return, it hurts so much more. For us, we just look and say, well, it's part of the cycle, but it's not. They had this cocaine hit. They were waiting for a positive return, and they got a negative, and it hurts a lot more, which leads clients to then say, well, I want to go into cash. This is dangerous. Let's protect it.
And that's like, which is hard to know how you're going to react or how it's going to feel until you actually experience, isn't it? So you can have the theory, and you can go through and say, oh, no, I'm happy to take a bit more risk in my portfolio, because you're thinking about that, as you said, cocaine hit, the gain. However, it's not until you see the market go down, or you get your statement and you sort of go, oh, actually, that doesn't feel very good, and that changes your sort of thought on it.
I've always been tempted to show clients, when you do an annual reviews, to have sort of a fake investment report ready for them, where it's had huge losses, and see their reaction to gauge it. But I think we know what their reaction is. They're not going to take it well. And so part of our work with clients is to try and prevent that from happening, that the negative returns are going to be there at some point, but to manage the behavior that comes out of that. Action bias is the idea that we, by acting and making sort of a movement, it creates a better outcome. And so if you imagine you're on a freeway and there's sort of 5 lanes, and it suddenly starts to slow down, what you start to see is people jumping lanes. They won't stay if they're in the fast lane and it's now one of the slow ones. They keep moving around. And it's this inbuilt bias that if we move around and if we help it along, we do some action, it's going to get us a better outcome. And again, when it comes back to investing, if the market's falling, well, don't just watch it, Jeff. You've got to do something. Let's go into cash. Let's wait it out. And so we feel that if we make some sort of movement, it's going to help our outcomes over time.
I can see that. We've got about 10 minutes to go, so let me know if you want to skip through or keep going through a couple of lessons.
I guess we'll maybe just touch on the patterns one, and I think that's quite, it'll tie into something we do a bit later, but it's the research done with that shows that people typically are looking for patterns. So when it comes to investing, you find those technical analysis tools where you can track and say, what did the share do? We know where it's going to go now. And we can identify simple patterns. So, years gone by, we know, okay, it's going to rain at this time of the year. We plant our crops at this time, and it's a pattern you can repeat over time.
Yeah.
But when it's a complex calculation, we look for patterns that don't exist. And you'll find it if you look for it, but it's not there. And so there's a great one, be aware of time. There's a great one in Monte Carlo where there was an incident with the roulette wheel, and they were betting on black or red. And it's roughly a 50%, I think it's 47% chance of landing on each one. And there was a streak of 18 blacks in a row. So the casino was making a killing. And everyone was feeling that the next one's got to be red because, well, it's got to be. But it doesn't, because it's a 50-50 largely chance.
Yeah.
And so by looking at the pattern of, well, it's got to be red now, it's going to red, didn't actually work. And it took 32 turns on black before we had a red, and the casino cleaned up.
Yeah.
They made an absolute fortune.
Yeah. So it's finding patterns where there isn't a pattern, and
exactly.
forgetting the fundamentals.
Yep. Yeah. And often, the pattern might work out for you at that point in time, and then you become overconfident.
Right.
And because, and you're tying it with hindsight, which is the last one. Hindsight is where everyone knows we always knew what was going to happen. We always knew Brexit would happen. We knew Trump would happen. Yeah. We knew the 2008 market crash would happen. We didn't act upon it, but we knew it would happen. And so we convinced ourselves that we knew it was happening, which plays into overconfidence, and all of those things start to play out.
So good timing. We're going to get on to what can we do to limit some of these things, because, I guess we've so we've got a question coming through. I'll have a quick look at that. We'll come back to that. Thank you for the question. Keep them coming through. So, we've talked about what people can do wrong and how things are built in. We're hardwired for these things. So now let's try and give some people some good news and talk about, what can you do to limit some of these mistakes?
I guess the bad news, in a sense, is if you look at the people that are far smarter than potentially you and I, and the Nobel laureates that have written this information, even knowing it isn't going to stop you from doing it. So we know we should eat healthy food, we still have junk food. We know we should exercise every day, we don't always do it. So knowledge alone isn't going to save you from it. And so there's a couple of things we put here, for instance, having rules in place or using a checklist. So the rule might be don't have more than 10% shares in 10% exposure in one share. You may say, well, only have 10% exposure in your employer's share. And if you look back to Enron, that's why you do it. And if you were in Amazon, you'd say, hang on, it's not great.
It's hard, yeah. It's
very difficult to, and it's easy to say it here, but it's to try and coach our clients into this, because it's an ongoing thing. It's not something we can do with clients once off. It's an ongoing relationship. And I think the checklist one, if you look at pilots, as soon as there's an issue on the plane and engine's on fire, they don't start panicking and using system one. They open a checklist and they start methodically going through it. And so we would suggest that's one way that we can try and do it. And often that's used in conjunction with an advisor, is how you go about it.
It's also referring back to your plan, isn't it? If you have a plan and looking back and saying, well, why did I take this action in the first place? Why did I make this investment? What was I hoping to achieve? Is that still a relevant goal or target or plan? And if it is, then has anything else changed, which means I should be making some different actions?
I guess maybe if we can look at that question, Jeff, that came through at this stage, and if you maybe pull that question up just to see exactly the wording, but the wording was around when the markets are falling and a client wants to go to cash, how do you respond? And I guess that's part of, as you're alluding to now, it's going back to the fundamentals of saying, what does your financial plan say? What was the intention of this money? If the money is going to be used for your retirement in 20 years, it's important what's happening now, but it's unlikely to have a huge effect unless you act upon it. And so the natural instinct, as we've spoken about, is to go to cash, is to try and illustrate to clients, we've been through this before. This is how markets have reacted. And I guess if we picked up a client just before a market crash, it's not ideal because it takes time to build the trust that the clients trust us. They're aware that we've got their best interests at heart, and we can educate them on these sorts of matters and build up that relationship over time.
And I think it's about using that checklist when you're putting the plan in place, which means you're not going to have that overexposure to one stock, and you're going to have some money in cash which is available to you and this sort of thing. So, so it's not all about relying on everything in being invested at the moment.
Correct. Yeah, exactly right.
Yeah.
Ask another question. This is a great one that's come out of the behavioural work. And so, if we saw a graph sloping upwards and we said to ourselves, will this continue going up? The immediate reaction is yes. And it's system one kicking in to answer the question. And what system one does, it answers a different, easier question. So in that instance, what the brain has answered is saying, has the graph been going up? And it's an easier question. The brain's trying to answer quickly, and it takes a shortcut and answers an easier question. And the answer is yes. So, ask another question would be, why has it been going up? What's the evidence that will support it still going up? And sort of being a bit of devil's advocate to your own thinking is a way to question what you're doing and why it's doing what it's doing.
Yeah, I've heard people talk about asking a question, why could this not be the case?
Yes,
the
exactly.
answer is yes, it is going to go up. And okay, well, why could that not be the case? Or how could that not work out?
Exactly.
Yeah, makes sense.
Next one, be careful of who you listen to. If you're watching the news every night or watching financial shows, they typically aren't geared towards helping you invest for the long term. They're selling clicks. And so it's unlikely to make a huge difference to you on a day-to-day basis. So often, as a family, we sit and watch the news at night, and the financial news comes on, and I show the kids that they've got the stocks, what are the best stocks of the day, and it doesn't help any of my clients. They said to me, do your clients care about this? And I said, I hope not, because it's not going to have a material difference to their portfolio. They might own, if they've got some indexing and some active managers, they might own 200-300 companies. What 5 did out of that 200 is largely immaterial in the bigger picture from a long-term point of view. Yeah,
we were talking about that in preparation, weren't we? And when you think about it, what place does Tom Petrosky have doing his ComSec update on the news on a weeknight? Like, it's totally irrelevant to so many people, almost everybody. Yeah. Yet we've become conditioned to it, and obviously then it, as you said, sells more ads and creates more clicks.
Yeah. And I guess if we had a show with diversification each night and being actively positioned against different asset classes, no one's going to watch us. So it sells clicks. The last one is not to log in too frequently. There's a lot of research, and we won't go into it now, but the stock market is down about 48% of the time. Mm-hmm. So if you logged in every day, there's almost a 50% chance of you seeing negative return. So the less frequently you log in, the less chance you see a negative return. And if you look at that loss aversion, you don't feel that pain as much. So we feel like we want to keep track of it because we can sort of help it along. It's best to just leave it and let it sit out.
Yeah. We know there's a fund, it used to be a fund manager who's now retired from funds management, but he runs some education courses, a guy called Peter Thornhill. And he talked about, he's a really strong advocate for equities investing, share investing, and building an ongoing income stream, and doesn't really like real estate and that sort of thing. And he used to always talk about, if he was ever elected Prime Minister for the day, he'd only open the stock exchange 1 day a year. Yeah. So for the other 364 days a year, you couldn't trade your shares. Yep. And then you had to just that 1 day to look at it and say, well, what do you want to do? Yeah. Which is kind of like property, where people in Australia get caught up in property and say, well, property always goes up, but that's because you only trade it every 10 years. Yeah.
And no one puts on the news what were the best traded suburbs today. No. They don't show that. So you're not getting that sort of negativity or that positivity thrown in property.
Still do get some silly commentary around property, don't we? But it's not quite the same volatility in experience.
And I guess the last one is partnering with a professional, which we would then aim to go through those questions to build a plan. And we had some other work on that, but maybe we can save that for another webinar. Yeah. But there's a lot of research around that partnering with a professional and how we can help our clients achieve better outcomes.
Yeah, that's right. And that's, that's really where we see a big part of our role is to help clients to interpret the data and the information and know what to look at and help them to ask another question, or help them with their checklist and run through their checklist and kind of working through some of those things that we talked about now. So we are, I think, pretty much coming up right on time. If there's any other questions, now would be a good time to fire them in. As Bruce said, we've got a few other slides which we can make available when we post the presentation and the recording. Those slides will come through for you. So if you have questions about them, come back to us or to your advisor, and they'll be able to help you. Bruce is the guru internally, so he can come back and talk us about some of these interesting findings from some of the research he's done. And that's the one about logging in to say that, you know, the more activity, the worse your investment results are.
Yep.
And your behaviour is the key, which is, I guess, that the crux of what we've been talking about is, you know, that your behaviour, how you manage your portfolio and more so manage your actions, is the biggest determinant of your investment returns over time.
Exactly right.
So we don't have any more questions, so I'll wrap up there. Our next webinar coming up next month, we're going to be talking about aged care, where I'll be joined by Catherine and Melody from our office to talk about the process around aged care, the pitfalls and how to get prepared for that. So hopefully you can join us for that. But I'd just like to say thank you very much, Bruce, for sharing your passion and expertise in regards to behavioural finance and investing. Hope everybody out there found it useful and interesting. If you do have questions, as I said, the presentation will be made available on our website this afternoon. It'll also come out via a link via the newsletter next week. And if you have any questions, come back to us on that. But in the meantime, hopefully you stay healthy, wealthy and happy. And thanks for tuning in.
Thanks, Jeff.
Thanks, Bruce.
Thanks, everyone.